Joining me right now is BMO Capital Markets Chief Strategist Brian Belski. Also with us all morning long is Dagan McDowell and Rob Luna. Great to see everybody. Brian, great to see you. Thanks for being here. First, give us your assessment of the impact that higher capital gains taxes will have on the economy and the markets, in your view.
Good morning, Maria. It's not good, at least for a psychological basis. If you go back and look at history when we've raised taxes before on an individual basis, you don't get a lot of great market cycles, quite frankly, in terms of signals. You get better signals with respect to what happens on the corporate tax side. Just the numbers that you just talked about in terms of 40% plus are troublesome, especially given the fact that it's the top 1% earners that pay over 90% of the taxes anyway in this country. So from an impact with respect to spending, it's probably going to be less than most people think. I think the bigger issue from a psychological perspective in terms of the market are the corporate taxes. If corporate taxes do go to 28%, you're talking about a 6% hit on earnings with respect to S&P 500 earnings. It looks more likely that it's going to be a 25% tax rate. Then you're talking only a 3% hit, Maria. So why are corporate taxes more important? It's because these companies are the ones that are paying these people in terms of employment. And if you do see more of a jump, especially in the small business side, which I know Dagan talks a lot about, if you see a corporate tax increase, you're gonna see jobs really slow down, and I think that's really the focus of the Fed in terms of employment versus inflation. So I think the corporate tax side is going to create more fundamental issues than the individual tax side.
You know, the whole idea of having a competitive corporate tax rate really matters. And I know you and I were both focused on markets and the economy under the Obama administration when we had a 35% corporate rate, and we saw that string of acquisitions by American companies of Irish companies. Remember that, Brian, where you had a string of companies in America acquiring companies in Ireland and then moving their headquarters to Ireland because in Ireland you had a corporate rate of 9%. So what I always say is money is mobile. Will we see that kind of mobility again if the corporate rate goes too high?
I think there's a very good chance of it. What's really interesting is that we started to see reshoring, let's call it, after that massive onshoring that, of course, you and I saw following the great financial crisis. And, you know, it's going to be interesting to see what happens because with respect to inventory, it's about time and inventory. It's not about how cheaply you make the units. It's going to be how fast you can get the units to the companies. That's why the USMCA that President Trump put together is so important, because for all intents and purposes, it was really designed to use Mexico as a hedge versus China. And you already started to see a lot of companies leave China with respect to manufacturing. So again, over the next few years, it's going to be interesting to see what happens, especially in financial companies moving more to Ireland, let's say, because remember, their earnings are all domestic, where international companies, 40% of the S&P 500 revenues, are from outside the U.S. So tech companies in particular can be a little bit more let's say stringent, non-stringent, in terms of moving their revenue base around.
Yeah, I want to ask you about so many things. I want to get your take on the macro story right now, certainly, and the Federal Reserve as it kicks off this two-day meeting. But let me bring Dagan in. Go ahead, Dagan.
Brian, but is the market acting like this capital gains plan isn't going to happen right now? Again, because Joe Biden is spending so much political capital, and I'll just focus on, he's basically tearing apart our energy industry. Like half of this infrastructure plan is focused on reducing carbon emissions and ripping up the entire energy sector, our energy economy. And so he's throwing a lot out there. And I just feel like this capital gains plan is maybe a bridge too far.
No, I would agree, Dagan, and that's why we as strategists, and as I said with Maria, it's very difficult to look at how individual tax plans impact the market because it's very noisy in terms of the data. Easier to analyze, quite frankly, with respect to periods when corporate taxes go up. And we know, too, that Mr. Biden has been very clear in terms of his perspective. Take on COVID, then take on infrastructure, then take on corporate taxes. And so I think this capital gains tax may be pandering to the base a little bit, but I think it's going to be very difficult to get that through, and especially given the fact of you talked about in the top of the hour with respect to some of the changes demographically in the United States. So if he's going to do it, he better hurry.
All right, let me ask you about the Federal Reserve. The FOMC kicking off its April meeting today. Chairman Jay Powell set to deliver the commentary tomorrow afternoon. Brian, are you expecting any change in the language? We know that Jay Powell told us interest rates are going to stay at these low rock bottom levels for a long time, perhaps well beyond 2023. But the language with regard to inflation or what it would take to get the Fed's foot off the gas may very well begin, moving markets. So what would you expect from this statement and this meeting, Brian?
Well, I think our institutional investors that we speak with spent way too much time focusing on inflation in the first quarter, Maria. It forced them to sell tech way too soon. And as interest rates, everybody was already decided that the 10-year Treasury is going to 2%. Well, funny thing happened. We saw a bond market rally as investors around the world came back to the United States and not only bought stocks, but they bought bonds. But I think you may hear him talk about transitory risk with respect to inflation. Remember, we've been looking for inflation, waiting for inflation for 39 years. We've had a 40-year bull market in bonds. And so I think you may hear him talk about transitory signs of inflation, maybe multiples on the stock market, especially given the fact that we have this big run. But it's very clear, don't fight the Fed. Everyone's trying to outthink themselves. The Fed's not going to raise rates until 2023 or at the very earliest, the fourth quarter of 2022. And this whole notion of a taper this year is ridiculous.
Yeah. Real quick on the macro story. We're in the middle of earnings, Brian. Big techs, Alphabet and Microsoft going to be reporting their quarterly numbers after the close tonight. Other companies expected are Starbucks and Visa. What do you glean from earnings, and how does the macro story look to you today, Brian?
Well, I'll tell you what, Maria, they're doing their job, right? Stocks lead earnings, which lead the economy. We saw unprecedented price performance last year in both directions. In terms of prices, we're seeing unprecedented earnings. Those people calling for an earnings peak in the first quarter, I think it's too early. I think second quarter earnings are going to be better than everybody thinks as well. And tech companies are doing their job. And that's why tech, communication services, and discretionary are our favorite sectors over the next 3 to 5 years.
All right, we'll leave it there. Brian, it's good to see you this morning. Thanks very much.